Total household debt in the United States has reached $18.6 trillion. Behind that record-breaking figure is a $13 trillion mortgage burden that is currently creeping upward for millions of citizens. If you're finding it impossible to secure a modest starter home, the obstacle isn't a lack of personal financial discipline. You are navigating a market that has shifted beneath your feet. Every time you place an offer, you are now bidding against multi-billion-dollar private equity firms with near-infinite capital. These entities are systematically acquiring properties with a singular motive: to convert entire residential neighborhoods into permanent corporate-owned rental complexes. The vanishing of the American middle class is being accelerated by this structural shift, a transition from a nation of owners to a nation of permanent renters. Following the 2008 crash, banks were forced to stop issuing the toxic ninja loans that had nearly collapsed the global economy. This sudden tightening of lending standards left a massive void in the housing market. Private equity firms realized that rather than packaging risky loans, it was far more profitable to own the physical houses themselves. For over a decade, the Federal Reserve held interest rates at virtually zero. This era of free money made the cost of corporate borrowing lower than it had ever been in modern history. Cheap liquidity flooded the market through a cross-currency carry trade, borrowing from global central banks at near-zero yields for domestic shopping sprees. While corporations issued debt at massive discounts, the traditional mortgage market for the average citizen grew more expensive and restrictive. These policies handed Wall Street the financial firepower needed to bankroll a massive takeover of the American neighborhood. When a modest 3-bedroom starter home hits the market today, it instantly becomes a battleground. A regular family has to beg a bank for a 30-year loan, scrape together a 20% down payment, and wait weeks for approval. But institutional buyers deploy algorithmic models to spot undervalued properties and bypass the banking system entirely. They swoop in with all-cash offers that regular buyers cannot compete with, driving a for rent sign into the lawn the moment the deed is signed. When inflation rose and the Fed hiked rates, consumer mortgage costs spiked to 20-year highs. This effectively locked the middle class out of the market, while capitalized whales simply held their inventory, waiting for rental demand to boil over. By constraining the supply of homes for sale, these landlords transfer the entire weight of economic risk onto the captive consumer. Institutional investors are hunting for consistent bond-like yields funded directly by the paychecks of a middle class that can no longer afford to own property. Wall Street has figured out how to extract a monthly subscription fee for your right to exist indoors. Official economic reports claim that GDP is growing and consumer spending remains strong, painting a picture of a healthy recovery. But because of Goodhart's law, our primary economic metrics have stopped reflecting reality. Spending isn't high because people are wealthy. It's high because they are using credit to bridge the gap between their income and their rent. Credit card balances have crossed $1 trillion at 21% interest. Families are now utilizing buy now, pay later installment plans just to afford groceries after handing half their paycheck to a corporate landlord. This system ensures that the whales get the compounding wealth and the tax advantages, while the citizen pays off the whale's debt. The system isn't broken. It is operating exactly as designed. You aren't struggling because you failed at the game. You are struggling because you have become the product. The rules of the market were rewritten to prioritize institutional equity over individual ownership, leaving the average citizen to pay a premium just to have a place to sleep.